Hey everyone, welcome back. For years, you've been the architect meticulously building an immense value portfolio, guided by the value doctrine. You've been laser focused on your North Star, that number. That means freedom. But what happens when you get there? Or even pass it? That's when the game changes entirely. The relentless pursuit of growth has to give way to the careful art of preservation and income generation. Today, we're diving deep into the deceleration strategies, critical shift from accumulation to distribution. First, let's talk about the psychological hurdle. Your brain? My brain? All our brains are wired for growth? We've spent decades chasing compound returns, but the strategies that got you here, like high-growth stocks or venture capital, are packed with volatility. That volatility is a powerful ally when you're 30, but it can be catastrophic when you're relying on that portfolio to fund your lifestyle. A major market downturn could derail everything. So, we need to reframe our definition of risk. Risk is no longer about missing out on the next big thing. The real risk now is losing the ability to cover your annual expenses, what we call your freedom figure. It's about protecting the principal, not just growing it. The action plan here is simple but crucial. Systematically decrease your exposure to volatile, illiquid assets, your moonshot fund, and reallocate that capital into high-quality, income-producing assets. Think bonds, high dividend, stocks, and stable, income-generating real estate. It's a pivot from what could I gain to what can I not afford to lose? Now for the mechanics. This is where we build what I call the income fortress. The goal is to generate enough passive income to cover 100% of your annual expenses without ever needing to sell your core wealth-generating assets. You want your money to work for you? Creating a steady paycheck. How do we do this? With a technique called laddering. Imagine you need $100,000 per year to live your ideal life. Instead of just having a pile of bonds, you create a bond ladder or a CD ladder. You buy bonds or CDs with staggered maturity dates. For example, you could structure it so that $25,000 worth of bonds mature every quarter. This gives you a predictable, reliable stream of cash, just like a salary. This strategy minimizes the risk of being forced to sell assets in a down market and protects you from wild swings in interest rates. When it comes to stocks in your portfolio, the focus shifts to dividends. You need to apply a strict dividend filter. Look for companies with long, proven track records of consistently increasing their dividends. These are often the businesses with strong economic moats and stable cash flows we've talked about before. This ensures your income stream not only stays consistent but actually grows, hopefully faster than inflation, protecting your purchasing power over the long haul. Finally, we need a plan for actually spending the money via distribution strategy. Many people have heard of the 4% rule, but it's too rigid for the real world. A much smarter approach is the dynamic withdrawal rule. This strategy is flexible and adapts to market conditions. Here's how it works. In good years, when the market is up, you take your full planned withdrawal. You might even give yourself a small raise for the next year, say, adjusting for inflation plus 1%. But in bad years, when the market is down 10% or more, you must be disciplined. You either freeze your withdrawal amount, skipping the inflation adjustment, or even reduce it slightly, perhaps by taking 10% less. This single act of discipline is what prevents you from selling your assets low and permanently damaging your portfolio's ability to recover. Think about successful early retirees. Their superpower is often this flexibility. They see a market downturn not as a catastrophe, but as a signal to temporarily tighten their discretionary spending. They know that their withdrawal rate is the most powerful lever they can pull to ensure their money lasts a lifetime. So here's your action step for today. Calculate the annual passive income your non-volatile assets are currently generating. This means dividends, interest, and rental income. Now, compare that number to your freedom figure total annual expenses. The difference is the gap. That's the number you need to close through strategic, income-focused investing. This is the final, crucial step in securing your financial freedom. 4 months, we've journeyed together, building your financial fortress brick by brick. You've gone from laying the blueprint to mastering the deceleration strategy. You've secured your financial future. But what comes after security? What is the final, highest form of wealth? It's not what you possess. but what you transfer. This isn't about inheritance. It's about legacy. Today, we graduate from managing your money to managing your wisdom. Your most valuable asset isn't your stock portfolio or your real estate holdings. It's your system. It's the unique combination of rules, principles, and insights that got you here you are. Personal value doctrine, your asymmetric test. To ensure this survives, you must codify it. I want you to create what I call a family investment constitution or an architect's playbook. This is a formal, detailed document that becomes the guiding star for your family's future. What goes inside? First, your core rules. Document your personal version of the 50-30-20 rule. Your non-negotiables for taking risks, and how you mastered the discipline paradox we discussed back in episode 17. Second, your allocation strategy. Detail your capital allocation matrix from episode 19 and explain the logic behind your deceleration strategy. Don't just list what you do. Explain asterisk. Why asterisk? You do it. Finally, and most importantly, tell your story. Write down your inciting incident from episode 1, the moment that set you on this path. Share your ultimate purpose metrics. This playbook isn't just about transferring cash. It's about transferring wisdom. It's the ultimate defense against emotional, system-destroying mistakes that can wipe out a fortune. Now, let's talk about the next generation. Passing on wealth without the wisdom that created it is the fastest way to lose it. Studies show that the majority of fortunes are gone by the third generation. We're going to break that cycle. The solution is active apprenticeship, not a sudden inheritance. Start by giving them controlled exposure. Invite your children or chosen heirs to sit in on your quarterly allocation reviews. Let them watch you and your personal board. As we discussed in episode 22, grapple with real decisions. Let them see the process behind the choices, especially the tough ones. Then, create a value creation mandate. When you structure your trusts, remember Episode 7, tie the distribution of funds to demonstrated. This means a portion of their inheritance is only unlocked after they've successfully completed a significant project. Whether it's building a small business, achieving a high-level educational goal, or making a measurable charitable impact, they must prove they can create value, not just spend it. Look at families like the Rockefellers. They built family offices not just to manage money, but to actively teach financial literacy and embed their core values in every new generation. That's how a legacy endured. Finally, let's talk about your impact on the world, your philanthropic multiplier. Your legacy metric is the ultimate expression of your life's work. It needs to be structured for maximum long-term impact. Forget sporadic, one-off donations. It's time to think like an architect. The fix is strategic giving through something like a family foundation or, even more accessibly, a donor-advised fund, or DAF. A DAF is like a supercharged investment engine for your charity. You get an immediate tax deduction when you contribute, and that capital can then be invested and grow tax-free for decades. This multiplies your giving power exponentially. You control when and where the funds are dispersed, allowing you to make a much larger impact over time than you ever could with simple So here it is, your final action step on this journey to mastery. It's not about analyzing a stock or finding a deal. It's about cementing your legacy. This week, I want you to schedule a single, uninterrupted block of at least 5 hours. Your only goal during this time is to start drafting your architect's playbook. Begin with the core rules, the foundational principles that guarantee long-term stability for your family. This document is your final masterpiece. It's the proof that you didn't just build wealth. You built a legacy that will last for generations. You are the architect of your life, and now, the architect of a lasting legacy. You've made it. You've mastered the deceleration strategy, and your financial future is secure. You've built the machine. But what comes next? What is the final, highest form of wealth? It's not what you possess, but what you transfer. This is the legacy of experience ensuring the knowledge, systems, and mindset that created your fortune live on long after you're gone. Today, we graduate from managing your money to managing your wisdom. Your most valuable asset isn't your stock portfolio or your real estate holdings. It's your system. It's the unique knowledge, the investment rules, the business principles you painstakingly developed. From your initial blueprint to your personal value doctrine. So, how do you transfer something so intangible? You document and codify it. You must create a formal, detailed document. Think of it as a family investment constitution or your architect's playbook. This playbook isn't just a list of assets. It's a manual for thinking. It must contain 3 core components. First, your core rules. Your personal version of the 50-30-20th rule. Your asymmetric test for evaluating opportunities and how you mastered the discipline paradox we discussed back in episode 17. Second, your allocation strategy. Detail your capital allocation matrix and the logic behind your deceleration strategy. Why did you make those specific choices? And third, the most important part, the why. Share the story of your inciting incident. What set you on this path and what your ultimate purpose metric is. This document transfers wisdom, not just cash. It's the ultimate defense, protecting your heirs from making emotional, system-destroying mistakes. Now, let's talk about the next generation. Passing on wealth without the wisdom that created it is the fastest way to lose it. The statistics are stark. A majority of family fortunes are gone by the 3rd generation. Why? Because the money arrived without the mindset. The fix isn't a bigger inheritance. It's an active apprenticeship. Wealth transfer must be a gradual, hands-on process, not a sudden event. Start with controlled exposure. Involve your heirs in your quarterly allocation reviews. Let them sit in on meetings with your personal board. Let them observe the real time, especially the tough calls balancing risk and opportunity. Then, implement a value creation mandate. Structure your wealth distribution, perhaps through trusts, so that access to funds is tied to demonstrating. This could be launching a successful business project, achieving a significant educational goal, or making a measurable charitable impact. Look at families like the Rockefellers. They built family offices, not just to manage money, but to actively instill the family's values and teach financial literacy to every single generation. Finally, let's address your ultimate legacy, your philanthropic multiplier. This is the ultimate expression of your values, structured for maximum long-term impact. Sporadic donations are good, but strategic giving is transformational. Instead of just writing checks, establish a small family foundation or, even simpler, a donor-advised fund, a DAF. A DAF is an incredible tool. You get an immediate tax deduction when you contribute, but the capital in the fund continues to grow, tax-free, just like your investment engine. You can then disperse the funds to your chosen charities over time. This structure multiplies your giving power over decades, turning your initial donation into a much larger force for good. You are applying the same principles of capital growth that built your wealth to your charitable giving. So here is your final action step on this journey. It's time to begin! Schedule your first block of time at least 5 hours, uninterrupted. Start drafting your architect's playbook. Begin with the core rules, the principles that guarantee long-term stability and define your success. This is your most important work yet. Friends, we've reached the end of our formal training together. Think about how far you've come. You've built your fortress. You've conquered the inner game. You've mastered asymmetric risk, and you have established your legacy protocol. The journey from a mindset of scarcity to one of true abundance is now complete. But remember, the work is perpetual. This final chapter is the synthesis. We're revisiting the core lessons to define the ultimate purpose of this entire undertaking. If you forget everything else from this series, these 3 laws must govern your financial life forever. They are non-negotiable. First, the law of compulsory investment. This is your discipline. Pay yourself first. Automate that 20% investment fuel we talked about back in episode 2. Automate your R&D lockbox from episode 14. This single rule is what safeguards your future from your present self. Remember, consistency is the single greatest competitive advantage you will ever have. It beats talent. It beats luck. It beats everything. Second, the law of asymmetric action. This is your strategy. Only allocate your precious time and capital to opportunities where the limited downside is completely dwarfed by the unlimited upside. We broke this down in episode 16. Eliminate proportional risk from your life. Stop trading your time for money 101. Instead, focus on the high-impact 20% that drives 80% of your results. Just like we discussed in episode 9, this is how you create leverage and exponential growth. Third, the law of perpetual learning. This is your defense. Your financial firewall protects your capital, yes, but the 5-hour rule we covered in episode 8 protects your relevance. The moment you stop learning, your 1% upgrade skill begins to decay. Your intellect is the ultimate hedge against every single market threat. It's your greatest asset, far more valuable than any stock or piece of real estate. As we detailed in episode 29, your mind is your ultimate fortress. Now, for the final synthesis. This is the ultimate realization for you, the architect. Financial freedom is a means, not an end. It is a powerful tool designed for one purpose, to maximize your legacy metric and your unique human contribution. If you achieve your North Star but fail to maximize your freedom of time and freedom of thought, which we explored in episode 25, then you have failed the ultimate test. Wealth without freedom is a golden cage. So, use the capital you have secured to invest in 3 critical non-financial assets. First, impact. Fund the charitable causes that align with your deepest values. Use your wealth to become an agent of change and address the problems you care most about in the world. Second, health. Fund the optimal physical and mental routines necessary for you to execute at peak performance for decades to come. Health is the absolute prerequisite for all other forms of wealth. And third, truth. Buy back your time and space to pursue deep, unfiltered truth, whether that's through mentorship, research, or quiet contemplation. Your greatest gift to the world is your unique, uncompromised perspective. The difference between a story with a great ending and a truly great life is one simple thing: the willingness to remain the student, even after becoming the master. Your final commitment is not to wealth itself, but to the system that creates it. Honor the system. Honor the process, and use the magnificent structure you have built to pursue a life of meaning, impact, and profound curiosity. You've done it. The systems are built. The legacy is outlined. The financial fortress is secure. You've won the game. But a new, more subtle challenge emerges. Now that the money is secure, how do you secure the happiness it was meant to bring? This isn't about finance anymore. It's about philosophy. It's about mastering the final frontier, your own mind. Many who reach this peak fall into a trap called the hedonic treadmill. It's that feeling when the new supercar, the new mansion, only provides a fleeting high before you're back to where you started, needing another fix. Chasing happiness through consumption is like running on a treadmill. You exert a lot of energy, but go nowhere. The solution isn't to buy more, but to buy back your peace of mind. I call this the friction audit. Instead of acquiring more things, use your resources to strategically remove the small, daily frustrations that drain your energy. Think about it. That frustrating daily commute, the constant hassle of home maintenance, the endless administrative tasks. Use your capital to solve these problems. Invest in a driver to reclaim your time. Hire a world-class estate manager. Build a team to handle the minutiae. By eliminating these friction points, you don't just get a temporary spike in happiness. You elevate your entire baseline of well-being. Furthermore, leverage your freedom of time, which we discussed in episode 25, to actively pursue flow states. Flow is the antithesis of the hedonic treadmill. It's that state of deep, effortless concentration where you're so absorbed in an activity that time seems to melt away. This could be diving deep into your legacy project, mastering a complex skill like sailing or playing a musical instrument, or engaging in strategic philanthropy. These activities provide a profound and lasting sense of fulfillment that no luxury purchase can ever match. You're not consuming happiness, you're creating it. With immense success comes a hidden danger: social isolation. It can feel lonely at the top. You might find it hard to relate to old friends, and you might be suspicious of the motives of new ones. This is a critical threat to your long-term happiness because humans are wired for connection. The fix is what I call the shared experience mandate. Use your wealth not to show off, but to build genuine, deep connections. The key here is shared struggle, not shared luxury. Anyone can bond over champagne on a yacht, but true bonds are forged in the crucible of shared challenges. Fund a multi-day expedition through a harsh environment with a small group of peers. Launch a difficult philanthropic venture that requires your team to overcome real obstacles together. The difficulty and shared purpose will create relationships far stronger than any built on leisure alone. Your mentorship commitments, as we've discussed before, are also a powerful tool for connection. Guiding others on their own journey reinforces your purpose and combats isolation, grounding you in meaningful service. Ultimately, this final stage is about the ultimate allocation, the investment in your own identity. For years, you were the hustler, the builder, the accumulator. That identity served you well, but it's now obsolete. You must consciously transition your identity to that of the creator, the mentor, the contributor. Your value is no longer tied to your net worth. It's tied to your impact. To solidify this shift, I propose the daily contribution statement. At the end of each day, as part of your routine, ask yourself a simple question. Did my actions today increase the value of my legacy and my character, independent of my bank account? This simple act separates your self-worth from your net worth. It ensures that the person you become is far greater than the fortune you've built. And with that, our physical journey concludes. But the real work, the philosophical architecture of a meaningful life, has just begun. That is the one project that never ends. You've built your capital, you've designed your system, and you've honed your discipline. But what happens at the finish line? That final high-stakes moment when you're acquiring a business, forging a partnership, or selling a major asset, it all comes down to one thing: negotiation. This is where fortunes are made or left on the table. Today, we're mastering the psychology and tactics to ensure you always walk away a winner. First, and most importantly, let's talk about negotiating with your feet. The single most powerful tool you have is the genuine, disciplined willingness to walk away. If you need the deal, you've already lost. Think back to episode 19. Your financial firewall and diversified portfolio aren't just for security. They're your secret weapons in negotiation. They give you the power to say no. Before you even sit down at the table, you must define your batna, your best alternative to a negotiated agreement. What's your plan B if this deal falls through? Write it down! Your absolute minimum acceptable outcome must be better than that, Batna, if the terms drop below that line. You have the system in place that allows you to stand up, shake hands, and walk away without hesitation. That is true leverage. Next, let's exploit information asymmetry. In any negotiation, the person with the most information controls the outcome. This is where your commitment to continuous learning, what we called the 5-hour rule back in episode 8, pays massive dividends. I want you to apply the 90-10 research rule. Spend 90% of your prep time researching the other party. What are their needs? What are their constraints? What are asterisks? That asterisk alternatives. What's their internal company politics look like? Spend only 10% of your time rehearsing your own points. With this superior knowledge, you can set the initial anchor with confidence. An anchor is the first number put on the table. If you're selling, you start aggressively high. If you're buying, you start aggressively low. This single move frames the entire conversation and pulls the final number in your direction. Finally, we need to master the psychological game by maintaining emotional distance. An emotional negotiator is an easy target. You need to operate like a rational agent. Never, ever reveal that a deal is personal or crucial to your plans. Frame it in your own mind as just one of many asymmetric opportunities, like we discussed in episode 16. A powerful technique here is mirroring. Something former FBI negotiator Chris Voss champions. Simply repeat the last few words of the other person's sentence back to them as a question. For example, if they say, "We feel this valuation is a bit ambitious," you can calmly respond, "A bit ambitious." This encourages them to explain their reasoning, giving you more information and building rapport, all while you reveal nothing and remain in complete control. It's not about manipulation. It's about tactical empathy. It's about understanding their world to better achieve your goals. So here is your action step for this week. Think about the next significant negotiation on your horizon. It could be a salary review, a new client, or a major purchase. Before you do anything else, define your BATNA. Write it down. Stick to it, and be prepared to walk away. This discipline is the final piece of the puzzle that turns your financial system into a wealth-generating machine. You've systematically mastered the timeless principles of wealthy psychological frameworks, the traditional asset classes, the defensive protocols. But right now, the very ground beneath the financial world is shifting, driven by three tectonic forces: AI, blockchain, and automation. This is your final graduation. We're moving beyond merely investing in technology to using technology as the operating system for your entire financial empire. Let's begin with layer 1, AI. As your chief analyst, your mind is sharp, but it cannot compete with the sheer volume and velocity of global data. AI becomes your tireless, non-emotional analyst, giving you a decisive edge. The protocol here is automated signal detection. Forget spending hours poring over news or screening data. It's time to deploy AI tools. First, for portfolio surveillance. Imagine an AI monitoring your entire portfolio against the risk tolerance and asymmetric rules we established back in episode 16. UD. Get instant alerts like moat degradation detected in company X due to a new competitor patent. Second, for tax optimization, use AI-driven software that continuously scans global tax regulations and legal precedents. Just like we discussed in episode 20, it finds opportunities your human team might miss. Your tax strategist from episode 22 then validates the AI's findings. The principle is simple. AI doesn't replace your judgment. It provides superior, unbiased input so your judgment can be surgically precise. Next, layer 2, blockchain. As your security layer, this is about more than just crypto. It's about creating a framework for trustless, transparent, and secure operations. The fix is strategic asset tokenization and custody. Think about your illiquid assets from episode 21 and your legacy protocol from episode 28. Conduct a tokenization audit. Explore legally sound ways to tokenize fractional ownership of assets like investment properties or fine arts. This dramatically increases liquidity and simplifies transfer, especially for generational wealth planning. Then, embrace decentralized custody. Move your Hivalio digital assets off centralized exchanges and into secure, hardware-based self-custody wallets. You, and only you, hold the private keys. This eradicates the single point of failure we've worked so hard to avoid. A core lesson from our crisis protocol in episode 24. Finally, layer 3. Automation as your discipline enforcer. This is your ultimate defense against the discipline paradox we covered in episode 17. It ensures your system operates flawlessly, even when you're focused on other ventures. The fix is to build an end-to-end autonomous system where every recurring financial action is automated and interconnected. Your income from leveraged assets flows directly into your core compounding funds, Distributions from your income fortress from episode 27 automatically handle all bills and expenses. And crucially, you set up automated risk triggers will automatically sell small portions of overallocated assets and reinvest into underallocated ones, keeping your portfolio perfectly aligned with your strategic targets. Your final action step is this. Identify the single most complex, time-consuming financial process in your life right now. Is it tax analysis? Is it tracking your complex assets? This month, commit to researching one advanced AI or blockchain solution to streamline it. The future of wealth management is automated, decentralized, and intelligent. By mastering these 3 layers, you are not just managing wealth. You are engineering a truly resilient, perpetual system. We're building the future, one protocol at a time. We dialed in your systems and perfected your internal finance engine. But what happens when the entire game board gets flipped? I'm talking about the big stuff. Macroeconomic tsunamis like hyperinflation, debt, crises, or massive geopolitical shifts we touched on back in episode 20. Your perfectly optimized machine is still vulnerable to these global forces. Today, we're building the ultimate global defense. This isn't just about getting rich. It's about staying rich in real terms for decades. This is episode 34. First, let's build your inflation-proof core. Forget what you think you know about inflation. It's a silent thief that steals from different assets unequally. Your mission is to hold assets that either thrive in an inflationary environment or are contractually protected from it. How? Through real assets and floating rates. Your strategic exposure to commodities like gold, energy, and agriculture is non-negotiable. Historically, when paper money loses its value, these real, tangible assets hold theirs or even increase. And remember your real estate empire. From episode 4, rents and property values tend to rise with inflation, making it one of your most powerful shields. Next, look at your bond portfolio. Fixed income is a sitting duck when interest rates soar. You need to shift a portion of that into floating rate debt. These are instruments where the interest you receive adjusts periodically, protecting your income stream from being eaten alive. Now, for Pillar 2, stress testing your global portfolio. Your crisis protocol, which we designed in episode 24, needs a major international upgrade. It's time for serious scenario modeling. Once a year, you're going to sit down with your fiduciary wealth manager from episode 22 and run simulations. I want you to model 3 extreme but plausible scenarios. First, a high interest rate shock. What happens to your entire net worth if global central bank rates spike to 7%? Think about your bond portfolio and the financing costs for your businesses. Second, a major currency devaluation. What if the currency you hold most of your wealth in suddenly drops 20%? How does that impact your buying power and your import costs? And third, regional conflict. What if a geopolitical crisis erupts and disrupts a key supply chain for your primary leveraged asset? The point of this exercise isn't to scare you. It is to find the weak points in your jurisdictional agility and adjust your capital allocation matrix asterisk before asterisk a crisis hits. You identify the cracks in the armor now, so you can reinforce them on your own terms. Finally, let's talk about Pillar 3, the talent exodus hedge. The future of the global economy isn't just about where the money is. It's about where the smartest people are going. Economic booms follow human capital. The next great economic engine will ignite where regulation is smart and talent is concentrated. Your strategy? Frontier investment scouting. You're going to allocate a slice of your moonshot fund from episode 10 to actively scout and invest in emerging entrepreneurial ecosystems. We're not talking about Silicon Valley or London. Think specific, high-potential cities in Southeast Asia, Latin America, or Eastern Europe. Yes, it's risky, but the valuations are low, and the potential returns are astronomical if one of these regions becomes the next high-growth hub. This is pure asymmetric thinking, the core principle from episode 16. You're buying a lottery ticket with incredible odds. Look at the legends investors like George Soros. Their genius was in seeing capital as fluid, constantly moving it to hedge against or profit from macroeconomic shifts. They didn't just react, they anticipated. So, here's your action step. Identify the single biggest macroeconomic risk to your wealth right now. Is it inflation? A new tax regime? Geopolitical instability? Dedicate your next 5-hour rule session to finding one specific, non-correlated asset to hedge against that single risk. This is how you move from playing offense to playing grandmaster level defense. You won't want to miss what's next. You've built the system. You've mastered your own financial universe. But now comes the final, most complex challenge. The Dynasty Protocol. This isn't just about passing on money. It's about ensuring the fortress you've constructed remains intact, functional, and aligned with your values for 3, 4, even 5 generations. Today, we graduate from mere estate planning to generational wealth planning. Pillar 1 is your defense. The multi-jurisdictional trust structure. If you're operating with a multi-million-dollar, globally diversified portfolio, a simple will or a local trust is like using a garden fence to protect a fortress. It's completely insufficient. You need a structure engineered for tax efficiency and legal protection across borders. The solution is a combination of dynasty trusts and foreign trusts. Dynasty trusts are legal marvels. They are designed to last for multiple generations, often using specific state laws to bypass the old rules that limited a trust's lifespan. What does this do? It shields your core assets from estate taxes, creditors, and even the financial fallout of a divorce, ensuring the capital remains within your family system, compounding for a century or more. For those of you with significant international holdings, a strategically located foreign trust adds another layer. Think of it as a global hedge providing enhanced asset protection and tax flexibility, guarding against severe domestic, legal, or political risks. Your first action item is to consult your tax strategist and your legal board about this immediately. Pillar 2 is the wealth education curriculum. As we've discussed before, transferring money without transferring wisdom is a recipe for destruction. Your goal is not to create passive recipients of wealth. It is to forge competent stewards who understand the responsibility that comes with it. We do this with a 3-tiered financial competency model. Level 1, for ages roughly 10 to 18, is all about the fundamentals. Financial literacy, budgeting, and the magic of compounding. A great tool here is using matching grants. The family matches the money they earn and save, teaching the power of delayed gratification and investment from a young age. Level 2, from 18 to 25, gets more sophisticated. The focus shifts to taxes, debt management, and understanding your family's core values. At this stage, the heir should be given a small, controlled investment portfolio to manage. They must then report on its performance to the family council. This isn't about the returns. It's about the process and accountability. Level 3, for those 25 and older, delves into the high-level strategy, complex asset allocation, philanthropic strategy, and system-wide risk management. The heir now gets exposure to your personal board of advisors and may even take a non-voting role in the governance of the trust. Remember, in this system, competency unlocks access. It is earned, not given. Pillar 3 is a sustainable philanthropic vehicle. A large-scale, shared mission is the glue that unites generations. It prevents wealth from becoming a source of aimlessness or entitlement. Your fix here is either a private foundation or a large donor-advised fund. A private foundation offers maximum control over your mission and grant making, and it's the perfect vehicle to engage the next generation in meaningful work that reflects your family's purpose. But don't just give money away. Apply the same strategic mindset you used to build your wealth. Embrace venture philanthropy. Instead of just funding a charity, you invest capital into social enterprises or nonprofits that have a clear, scalable business model for creating systemic change. This aligns your giving with your core skills and multiplies your impact. Look at the families who have successfully sustained their wealth for over a century, like the Rockefellers. They don't credit their longevity to smart stock picks. They credit it to mandatory family meetings, robust educational structures, and a shared set of values that reinforce the responsibility of stewardship. They built a culture, not just a portfolio. So, your final action step from this entire series is this. Schedule a meeting with your top legal advisor. Your agenda is to discuss the specific structure and feasibility of a dynasty trust for your long-term assets. The system you've built is a masterpiece. Now, ensure it operates flawlessly for those who will follow you. Build a legacy that lasts. All right! Let's get started! We've relentlessly optimized every single financial variable in your life. We've built the systems, allocated the capital, and designed the fortress. But I have to tell you, all of that work, all of that financial architecture, it's all for nothing if we ignore the foundation it's built upon. Wealth management, at its highest level, isn't about managing money. It's about managing your life. The greatest risks to your long-term well-being, the things that can truly destroy everything you've built, aren't market crashes or bad investments. They are non-financial. I'm talking about poor health, crippling isolation, and a profound lack of purpose. These are the silent destroyers of the very freedom our entire system was designed to create. So, today, we're doing something different. We are turning our rigorous audit framework inward, applying it to the most critical system of all, the human operating system. First, let's talk about the health audit. I want you to internalize this. Your body is the single most valuable, non-negotiable asset in your entire portfolio. Forget stocks. Forget real estate. A catastrophic health event is the ultimate destroyer of your finances, your time, and your freedom. It can wipe you out faster than any market downturn. The fix isn't reactive. It's proactive. We need to implement a bio-optimization budget. This means allocating non-negotiable capital toward your health, treating it as your primary defense against catastrophic downside risk. Think of it this way. First, you invest in preventative diagnostics. I'm talking about advanced, annual, full-spectrum, testing genetic, metabolic, and cardiovascular screens. This is the ultimate asymmetric bet we talked about in episode 16. It's a small, manageable, upfront cost to prevent massive, life-altering future losses. Second, you make a performance investment. Budget for personalized nutritionists, professional exercise physiologists, and high-quality sleep technology. Remember our discussion on peak cognitive performance in episode 9? Your work demands it! You have to treat your biology like the high-performance machine it is. Next, we need to build a relationship firewall to combat the risk of isolation. It's a strange paradox. As your wealth increases, genuine, unbiased relationships become incredibly rare and infinitely more valuable. Social isolation isn't just a feeling. It's a key predictor of both physical and mental decline. The solution here is what I call a focused circle investment. Just like you audit your financial investments, you need to audit your key relationships. This involves 2 steps. First, active pruning. Be ruthless here. Prune relationships that are purely transactional, that drain your energy, or that exist only because of your money. The low-profile protocol we covered in episode 17 is a huge help with this. Second, high-value allocation. You must consciously dedicate time and resources pulling from your experience portfolio from episode 25 to actively deepen the relationships in your focused circle. This is your family, your true mentors, and your genuine peers. Shared, challenging experiences build trust and loyalty. That is the real soft leverage we discussed back in episode 15. Finally, we have to conduct the meaning audit to close the purpose gap. Achieving financial freedom is the goal, but it often leaves a void. The chase is over, and an emptiness can set in. This lack of purpose is dangerous. It accelerates mental decline and can even lead to self-sacrifice. The fix is the legacy time mandate. I want you to treat the time spent on your legacy metric your ultimate purpose from episode 14 and your philanthropic goals from episode 35 as a compulsory, non-negotiable allocation, just like your monthly investment contributions. And this isn't about just writing a check. It's about active contribution. Use your unique skills, your hard-won expertise, to solve real problems in your chosen domain. Your specialized knowledge is often far more valuable than your money alone. So, here is your action step for this quarter. I want you to schedule your most rigorous non-financial audit. Yet, book that advanced health screening. Schedule that high-value weekend with your focused circle, and block out 2 hours on your calendar this week to actively advance your legacy metric project. This is how you protect your ultimate investment. Your life? We're moving beyond systems, finance, and health. We're tackling the one asset you can never get back. Time. This isn't just about being rich in money. It's about becoming a time billionaire. This is the final, ruthless optimization of your minutes. We're graduating from managing time to owning it, ensuring every moment aligns with maximum value and fulfillment. First, let's talk about the principle of nonlinear time. Here's the truth. Not all hours are created equal. 1 hour spent on your 1% upgrade skill at your peak energy is worth 10 hours spent clearing out your inbox at 4 in the afternoon. So, what's the fix? It's what I call the value density audit. You need to rigorously track your time for 1 week. Identify the activities that produce the greatest return per minute invested, whether that's income, learning, or pure fulfillment. These are your high value density activities. Once you identify them, you must ruthlessly eliminate everything else. I mean everything that has a low value density, even if it feels productive. I'm talking about unnecessary meetings, mindlessly scrolling through news feeds, or organizing files you'll never look at again. Then, you implement time chunking. Physically, block out 3 to 4 hour chunks in your calendar for deep work on your highest leverage tasks. Protect these blocks fiercely. Do not let them be broken up by notifications, calls, or low priority distractions. This brings us to Pillar 2, the communication constraint. Communication is the single greatest destroyer of high-value time. Constant notifications, the pressure for immediate responses, and unfocused meetings completely shatter your attention and erode your focus. The fix here is to make asynchronous communication your default setting. This means shifting your entire operation to allow for delayed, thoughtful responses. It's the only way to maximize your deep work time. How do you do this? You start batching, schedule fixed, specific times each day for checking and responding to non-urgent communication. For example, maybe you only check email at 11 a.m. and 4 p.m. Train your team, your personal board, everyone you work with, to respect these boundaries. It will be hard at first, but it's essential. Also, use the medium filter. Use the communication method that requires the least amount of time for the information you need to share. Simple facts. Send a text or an email. Complex feedback. A quick phone call is better. A formal meeting should only be used for major, collective decision-making. Period. Finally, Pillar 3. The time-based legacy. Think about this. Your greatest legacy isn't the money you leave behind. It's the time you dedicate to others, to creative pursuits, and to things that have nothing to do with making money. The fix is the unscheduled space allocation. You have to consciously and deliberately block out time on your calendar that is completely unscheduled. This time isn't for work, errands, or even networking. It's for creative thought, for spontaneous moments with family, or for pure, unapologetic rest. This unscheduled space is your discovery engine. It's in these moments of quiet that your mind makes its greatest connections. It solves the problems your conscious mind has been struggling with. This is where your next asymmetric idea is born, where your greatest personal insights are found. It's not wasted time. It's incubation time! So here is your final action step for this episode. I want you to open your calendar right now and audit the past week. Identify the top 2 activities that provided the absolute lowest value density. The 2 biggest time wasters. Got them? Now, commit to eliminating or delegating them. Starting today. Not tomorrow, not next week, immediately. This is how you stop managing time and start owning it. Thanks for watching. If you're serious about this journey, make sure you subscribe so you don't miss what's coming next. We're just getting started.